All right, let's go ahead and get started. So, a few things logistically. Today, just checking to make sure that everybody had invested the proper amount in your trading sim, which looks like everybody met the spirit of it. So again, you need to stay at 300,000 or less in cash the rest of the semester. I know it's very early, but basically this is the ranking as of today. It's based on portfolio value from first through last. All right, so again, if the competition were to end today, 5, 4, 4, 3, skip 2, 1 would be the points in the distribution. Okay. Obviously, we're not ending today. We're going to end on March 25th. But regardless, it looks like almost all the teams have already made the minimum amount of trades, except for one. So, again, good start with at least the allocations. But right now, this is pretty close between first and last. Obviously, we just started last week. But nonetheless, we'll kind of keep track of how we're doing in the trading competition as we go forward. All right? Yes, sir.
Do we get a warning when we get, like, if our portfolio cash goes to the...
I'm giving you the verbal warning now.
That's it?
And unlike Major League Baseball, there will be suspensions. Okay? So yes, your warning is don't do it. Okay? All right. Anything else? All right. So a couple more things. They're coming up logistically. So Monday, 1 week from today, Group Project 1 will be due. Okay? Group Project 1 is the first of 3 mini presentations that are worth 5% of your semester grade. All right? This presentation will be on EIC. Right? Your team will have up to 10 minutes to make your EIC presentation on a company that I'm assigning today. I'll be sitting over there. I'll have my iPad with a countdown timer. At the end of the 10 minutes, you're done, which includes your presentation and any Q&A based on questions that I will ask your team. Okay? We're going to go through all of the teams. So we got 6 teams in this section. So basically the whole hour, one team right after another, all presenting on the same company for EIC. Okay? So again, this is going to be a little quirky, but there's going to be 3 presentations you're going to make. The next one's coming up a few weeks thereafter. The first one's on EIC. Second team presentation is going to be on historical analysis, which we're going to cover in class today. And the third presentation is going to be on the bull bear target valuations, which we'll cover next month. Okay. So again, across those 3 presentations, which your team will present for a grade, however many members of your team, those members have to present across all 3, but they can only present in one of the 3. Okay. So whoever presents next Monday cannot present in group project 2 or 3. Okay? And all team members have to present across those 3 group projects. Now, whoever's presenting is presenting on behalf of the team, and it's a team grade. Okay? So you guys can decide strategically who you want to go first, but nonetheless, they are the ones that are going to be presenting 1 week from today. Okay? So it's just a PowerPoint. There is no paper for this. But like everything else we do in this class, it must have supporting data. So if you don't have the screenshots, if you don't have your data references, it's like it's not there, no matter what you say in class. So make sure all of your supporting data is in the PowerPoint that you will submit. All sections need to submit by 10 a.m. 1 week from today, the PowerPoint that you're delivering that day with a 15-minute grace period. One person per team will submit that PowerPoint. That's the PowerPoint that you will present off of. So you can't use your own PowerPoint after that. You're going to use the one that you submit. I will download from your submissions all the PowerPoints, and I'll load it onto the main computer in this room, that old creaky computer over there. Okay? You're going to present off of that using the PowerPoint that you submitted. And again, you can't go to anything else. You can't go to the web, can't go to Excel, can't use Bloomberg in the classroom. So everything you need in your presentation needs to be embedded in that PowerPoint. And you're going to get 5% of your semester grade based on that PowerPoint presentation. Okay? Now, again, there's no dress code for this one. So you can come as you are. And I'm going to reward content over style points. Meaning, if you're nervous and you want to write down what you're going to say, I'd recommend doing that than not writing down what you say and then forgetting it. All right, so that is going to be more important to make sure you cover the content. So if you need to write down some index cards or whatever, to help you, that's perfectly fine. But regardless, you decide who on your team is going to make this presentation. Now, because we have 6 presentations and you're all doing the same company, there's a huge advantage to going last because you can see everybody. So therefore, all the teams that are presenting will be in the room except for the presenters. The presenters are going to be milling out in the hall. Matter of fact, I don't care where you are, just you're going to be outside this room. When it's your turn to present, you will come in and you will present. When you're done presenting, you'll then sit down and politely listen to everybody else. Okay? But nonetheless, the people that are presenting won't have seen who presented before them. So those members of the team will be out in the hall, and as you are presenting every 10 minutes, we'll go grab the next team, bring you in to make your presentation. I'm doing that to mitigate against the fact that there's a big advantage to going last, okay? Because I just don't want everybody to see since we're all doing the same company, right? Now the company, which is already listed in the assignment, is a company called Parker Hannifin, okay? They're a part supplier in the defense, aerospace, and aircraft business, right? So other than that, you're going to educate me about them. I assume you don't know too much about Parker Hannifin. They're based in Cleveland, Ohio, but nonetheless, we're going to do an EIC on them. And again, the requirements are very similar to your individual homework. I put them up there in there, but basically the E. You're going to talk to me about what's going on with the economy, and you're going to talk to me with the beta screenshot about the sensitivity of the industry and the company. I got a question in the last class about what comp source. At this point, training wheels are off. You tell me what the applicable comp source should be and what the industry should be. I'm going to let you guys figure that out and tell me. Okay? Make sure you have the screenshot for that industry beta. Then, for the industry, in the I, you have to have a screenshot using operating ROIC, very similar to this homework, and the WACC. So it's the operating ROIC spread to define industry attractiveness and competitive advantage. All right, got to have that screenshot. In addition, you're going to have a 5 forces for today and a 5 forces for 5 years out. You got to explain the changes and how it affects the spread, and you got to discuss the competitive advantage today and the potential changes in competitive advantage over the next 5 years. Okay, that's basically what's in your PowerPoint. You'll have up to 10 minutes, and I will ask questions. And then the answers to your questions will be about the company and the EIC, which again will impact your grade. Now, any member of your team can help with the answers to the questions. So if you have 2 out of 7 people that are presenting, the other 5 can help you with the questions, but they can't present. So you have to decide who is presenting, and I need you to list all your team members just for grading purposes, and specifically who is presenting. Because when we grade the later ones, we've got to remind ourselves who can't present in the later presentation. So section this out. Here's our team members, here's the presenters for this presentation. Okay? And you'll be graded on what you submit and what you cover in class. I'll give you your grades at the end of class. Right? Rubric is already basically up, but it's basically the EIC. Questions about that presentation? All right, that is due 1 week from today. So to assist you, we are not going to have a lecture on Wednesday. This Wednesday is going to essentially be, I'll call it a Bloomberg lab. I'm going to leave the lab open all day so your teams can work on getting the data and collectively work on the EIC assignment. So there is no lecture this Wednesday, right? However, we are going to finish lecturing today on the content for Homework 4. Homework 4 is an individual assignment which will also be due Monday at 10 a.m., which is on the ROIC trees and the CFI analysis, which we're covering in class today. Okay? So those are both due on Monday. Individually for all students, Homework 4, group assignment 1, due 10 a.m. for each of your groups, and then come ready to present Monday during class. All the teams will present on Monday. Okay? The following Wednesday, which is February 26th, Bloomberg is coming to guest lecture the entire day. So we'll be hosting Bloomberg. As I told you, they're going to give you advanced terminal training, which will be a very nice feature. And remember, the people that are coming here are Bloomberg's recruiters. So by the way, this is not Mike 2020 campaign recruiters. This is Bloomberg LP, the company that he makes all his billions off of. So if you're looking for an internship or you're still looking for a long-term job, these are the people that do the hiring. Okay? So they're going to be here to do training, but they're going to stick around to do a recruiting event And if you're interested in working for them, they're good people to know. Okay, some of you might have already been interviewing with them, but regardless, I know it's later in the semester, but it's still a good opportunity to talk to them, even if you're a junior and you're considering next year. So, long story short, that's going to be on Wednesday, February 26th. Okay, and then shortly thereafter is the midterm exam. And the midterm exam is going to be a repeat of homework 3, basically an economic conversion for homework 3. Now, unfortunately, for some reason this semester, a lot of people have excuses that are causing them to not turn their homework in on time. And I have a lot of people who have, unfortunately for this assignment, who have deferrals until Wednesday. So I can't go over the solution today because there's still 2 more days of people working on the assignment. There's enough of them that I'm not going to post the solution. So I am going to post the solution on Wednesday, even though we're not having a class today, to the economic conversion on Wednesday. So please check that out. I'm also going to post another conversion, just example, like an example and which not for a grade, but basically a previous midterm, because this is similar to the midterm, that basically will walk through the conversion and a solution. So it's your chance to practice, because like I said, that's what you're going to have to do on the midterm coming up in 75 minutes. But relative to the homework assignment, first of all, for homework 3, I will mention a couple things. So first, here. All right. It was pointed out to me that I had 5 companies, but many of you had only found 4 companies when you did your assignment. Okay? And there's one person in the first section had 3 companies, which was inexplicable, but generally 5 or 4 is probably going to be accepted. I have a feeling the company that seemed to be missing is Edwards Life Sciences. My guess is they might have reported information, because that's the nature of our class. We're in the middle of earnings seasons, and because we're in the middle of earnings seasons, as companies are reporting numbers, Bloomberg is a real-time database, so it does filters for latest filing. That could have changed, right? So essentially, 5 or 4 is acceptable. These should have been the companies generally on the list, with the exception of the life sciences company. And what matters more than anything else is, did you get the right operating ROIC? Okay? And so the same is true for the industry spread, that for Nike, you should have 41.32 as your operating ROIC. That's the number that matters most, okay? Because that tells me if you had the 41.32 for Nike, regardless of anything else, that you had the right formulas. Right? If you don't have 41.32, then you're going to have to figure out what you did to change your formulas, because this is also going to be very important, for example, for the Parker-Hannafin assignment. So just like we did it for this one, you got to put the operating ROIC and the WACC in group project 1. So you got to make sure you got the right operating ROIC when you talk about the industry spread. Okay. So hopefully that part was straightforward. Any questions about these two, either the equity screening or the formulas, putting in the operating spread? No challenges with that? Yes, sir.
You said that we have to choose our comp source ourselves.
Yes.
So say that we choose the wrong one. Is there a wrong one?
Not necessarily. That's what I mean. The training wheels are going to start to come off. This is real world. So you're going to explain to me why this is the right comp source for that company, right? And so I'm not saying that you're going to probably choose a wrong one, but make sure that you're doing an analysis on one that you think is the most reasonable, okay? That represents the industry, right? So again, not saying that it's going to be that hard, but it's just, you got to start practicing. So I'm going to let you guys make some of your choices and tell me why you made the choices. And again, you can use other sources, IBIS World, BRC, BI, BICO, etc., to help you. Just make sure, even though it's a presentation, reference it. So if you're using other stuff, don't plagiarize even though it's a PowerPoint. So reference what you talk about. It's perfectly okay. All right, other questions? All right, so again, I'm not going to hand out the solution yet for homework 3. However, this is the one that I will post. I will mention a couple things that probably will confuse you based on history. But I'm guessing that most people got the TII and the TFI. Is that reasonable? Nobody shaking heads. The one that if you had trouble was probably in the CFI? Okay. Anybody not get the CFI? Not get the balance? Just willing to admit it? Okay. In any event, that's the one that probably gave you more trouble. So just a couple of things I'll just remind ourselves as we look at the statement, which are going to be important to the analysis we're about to do. First, you got to remember that these statements are not GAAP FASB. Okay? They're economic McKinsey. So they're a completely different set of rules. And the idea here is, particularly for the TII and the TFI, the CFI, is the name of the statement is kind of telling, meaning total income available to investors, cash flow available to investors. So what that means is the top half of this statement is either the income that's being generated or the cash that's being generated that's available to be paid out. So anything that adds to the income, positive numbers, or anything that adds to the cash flow, positive numbers, is going to add to the TII or add to the CFI. Okay? And the trickiest part of the statement is getting it to balance and getting the signs right. So the other thing is there's a big dividing line here to the second half of the statement, which is called the financing or funds flow side of the statement. And this is, again, unique to this class in that we're balancing these statements. So we're saying if we generate cash, where did it go? Right? So for example, in the CFI, the answer was 213.4 for the first year. So if I generate $213.4 million worth of cash, the other side of the statement is what did I do with the $213.4 million worth of cash? It has to balance exactly. And by the way, it's not an absolute value. It means it literally has to be 213.4. So this is where it gets tricky, because what it means is I have cash, therefore I have cash to pay out. Therefore, on the financing side of the statements, payouts are positive. Positive cash flow, positive payouts. Second year, negative 227. I'm short $227 million. That means I had to go find $227 million to finance this business. Therefore, negative cash flow, negative inflows from financing. I'm borrowing money to cover my negative cash flow. So whether I'm on the TII or CFI, that will help you just conceptually understand what these statements are about. Because they're about, I generate cash, I pay it out. Therefore, payouts are positive numbers, right? I lose money, I need to fund the losses, negative inflows. Got to borrow money, okay? So negatives mean I borrow money, positive means I pay out money on the financing side of the statement. That's just what's unique to these economic statements, TII, CFI. The other thing that's going to trip you up are the terms. There's probably some accounting things that you may be less familiar with, right? One of the things that you may be less familiar with on these statements, beyond the signs, is something called minority interest, right? There's minority interest on the income statement, and there's minority interest on the balance sheet. Does anybody know where that comes from? What generates minority interest? Anybody know? Your accounting? Yeah.
Is it like if you own more than 50% of the company, then it's like all reported on your financial statements, and you have to pay out the other percentage to like
That's exactly where it comes from. So it has to do with accounting rules that say if I control a company, which means I control more than 50%, own more than 50%, but less than 100, then I treat that company as if I own it 100%. So if I take that company that I don't own 100% of, but control, and I add 100% of their sales, 100% of their expenses, therefore 100% of their profits, I add 100% of their assets and 100% of their debt to my balance sheet, as if I own the whole thing. But I don't own 100% of those assets. There's a part of those assets that are owned by somebody else. That somebody else is called a minority interest on the balance sheet. So if you ever see a minority interest in the balance sheet, what it represents is the ownership slug of the minority shareholder for the business that I've consolidated, because they get a piece of my earnings. They don't get all of my earnings. They're not my common shareholders. They're shareholders that own a piece of the business that I consolidated. That piece that I consolidated of that equity is called a minority interest. Now what's interesting is it's kind of a quasi-liability, because minority interest is a liability to somebody else's shareholders, okay? So right now it's actually considered equity Matter of fact, FASB is considering reclassifying it as debt on the balance sheet. But either way, whatever it is, it's money I owe to those minority shareholders for the part of the business that I've consolidated. That's their ownership stake, right? Now, on the income statement, the same is true. I've reported all of the sales. I've reported all of the costs. And the government wants me to do that because the government wants me to pay the taxes. They don't want me chasing down a bunch of people for taxes. So I'm responsible for the taxes. Then some of those profits didn't belong to my shareholders. They belong to those minority shareholders. So I have to make a distribution after tax to those minority shareholders for the profits that they are entitled to. That's the minority interest on the income statement. Okay? So minority interest will show up in two places. On the income statement, it's the distribution to the minority shareholders. On the balance sheet, it's the amount that we owe their stake, the equity stake, to those minority shareholders. Okay? And in a way, it's kind of like if you don't pay it out, if you make profits, it's kind of like retained earnings, their minority interest stake just goes up. So if we have a joint venture and I control the joint venture and we make a bunch of profits and I don't make a distribution, then your minority interest stake just goes up. Okay? Matter of fact, if I overpay the joint venture, if I pay out more than what's distributed, then the minority interest stake goes down. So I just treat it like an equity account to that minority shareholder. Yes?
Can you explain the change in minority interest then, like how that?
So it depends. So again, in this case, if I go back to TFI is the place to see it. If minority interest doesn't change, that means that your ownership stake stays the same. But let's say that instead of 300 million, you had to put another 100 million in. So this went from 300 million to 400 million. Then that would be the same as if I just sold new stock. So I added 100 million of financing, it'd be minus 100 of my CFI. Right? Or the opposite is true. Let's say we had 300 million and I gave you $100 million that we did make in profit. I just bought down your stake. Then the 300 to 200 would be 100 million positive distribution of the CFI. So there's two parts of the CFI. So remember, CFI is just the income statement minus the change in balance sheet 4 times. So it's the income statement, change in minority interest. This is the distribution from the income statement. And that's the balance sheet change in minority interest. That's the equity stake. Those are the two. Other questions? All right, another term you may or may not be familiar with, treasury stock. Where does treasury stock come from? Yeah.
When you buy back your own companies.
Yeah, it's when you buy back your own company stock. It's called treasury stock. And so the reason why that becomes important is that when you issue stock, it goes into something called common stock at par and additional paid-in capital. And it's treated at book value. But when you buy back the stock, it's treated at market value. Okay? And they're treated as a contra account to your equity. So treasury stock represents the share repurchase, the market price of the share repurchases. So if a company has an increase in treasury stock of 245 million, that basically meant they bought back $245 million worth of stock. So this is a repurchase of shares. That's an additional repurchase of shares. Okay? And so, and this is very important, but when you actually buy back the stock as the company, you kind of take it out of circulation. So the company doesn't actually own and vote the shares. They just go out of circulation. And so the remaining shareholders own a bigger piece of the smaller pie. Okay? So essentially you're just taking stock out of circulation. But unfortunately, the way that the laws are set up, you can't actually cancel the stock that you buy it back. So it's called treasury stock as opposed to cancel the stock. So it just gets taken out of circulation. You could actually theoretically resell the treasury stock if you ever needed to. Okay? Now, back to this. What's going to be important when you get graded is that these two have to balance. And if they don't balance, then it's still considered a wrong answer. So if you had 213.4 and some other number down here, even though one of the two numbers is right, you still don't get credit. So to get credit in these statements, very important, not only must you have the right answer, but it's got to balance. Because that's the only way you know that you have a right answer. And that's the way that you're going to be graded on all of the assignments in this class. So make sure you balance the statements. And then the final one was on EP. make sure you did it based on BOI, EP, current year profit divided by last year's capital. All right, otherwise you're going to get the wrong economic profit. That was the BOI part of it. But again, explaining the video, I'll post the detailed solution on Wednesday. If you have any additional questions, we'll talk about it next week. Right? But here's the key. We're now going to start analyzing these statements. So let me just ask a couple of quick questions off the CFI. What does this number mean? Change in short-term debt, negative 160. What does that tell you? Yeah,
We paid back 160 in debt.
exactly. You paid off 160 in debt. What does this number tell you? 50 of common dividends. Yeah. What does this number tell you? Negative 130 change in excess cash. Yeah.
You paid $130 of your excess cash.
You did what?
You paid $130 of your excess cash.
Unfortunately, it's the opposite.
You made $130?
You took $130 and you put it into savings. So it reduced your CFI. Okay? So basically, like I said, the metaphor I used in the video, excess cash is kind of like your savings account. When excess cash, you have a negative there, what you're doing is you're reducing your cash flow to investors because you're taking cash and you're putting it into excess cash. Right? Positive numbers means you're drawing down your excess cash to be able to be paid out. Those are probably the most tricky ones that you're going to run into as you start to understand these statements. But like I said, we're going to start to apply this to real world. So let's talk about lecture note 4. Once we finish conversion, the next step is going to be to analyze these statements. Okay? And there's going to be 2 statements that you're going to be analyzing. One's called an ROIC tree, the other's called a CFI. So let's start with the ROIC tree. I'll give you the trees. We'll build trees, but I'll give you the trees. Our model that we're building in class will generate the trees. But what the trees do is it helps you understand the drivers of ROIC and therefore why ROIC is changing, right? There's 2 levels of analysis that explain every ROIC tree and every change you're going to do. Always 2 levels of analysis. Start out with level 1. ROIC changes can always be explained by these 3 things. Change in the tax rate, change in the operating margin, change in the productivity. Those 3 things always explain change in ROIC. Okay? So, we'll do a little drawing here. P over S is profit. Profit divided by sales. That's your operating margin. P divided by, it's hard to see, IC, probably should have done a different color, but P divided by IC or P divided by I is return on investment. Okay? Those are the 2 things we're trying to explain. This is profit margin. This is return on investment. The way we explain this is we multiply P over S by blank over blank to get P over I. So what is that? P over S times blank over blank is P over I. What must the blank over blank be? S over I. I don't even know what it is, just algebra says that has to be S over I. All right? S is sales, I is invested capital. This multiplication sign, equal weight, which means these 2 things are equally important in explaining your ROIC. Operating margin is P over S. Productivity, S over I. These 2 are the drivers to return on investment. The only difference, pre-tax, after tax, whether we include the tax rate or not. Driver number 3. So essentially, when we do the ROIC explanation, that's what we're focusing on. Yes? Invested capital or investment. Okay? Except, here's the one change we're going to make in this class. Is that in the real world, when you deal with companies, they don't think in terms of ROI. They think in terms of dollars of sales. How much did I sell to make a profit? What did I sell? What are my profits? What are my margins? Everything companies think about is in terms of sales. They don't think about in terms of dollars of investment. So S over I is kind of a foreign term to them. Even those investors, we care about return on investment. Sales to investment is a hard ratio for the average person to understand. Okay? So for our purposes, just to make it consistent, we're going to do the reciprocal. So instead of S over I, we're going to use I over S. I divided by S. Investment divided by sales. Just so we have profit divided by sales and investment divided by sales, so we have consistency between the two. So in our formula, it's going to be P over S times 1 over I over S equals ROIC. That's the way the tree is set up. So here's a tree, historically, for a company called McDonald's. Okay. I'll try and make it a little bit bigger. Now, when we're going through these trees, when we start with the training wheels, I'm going to ask you to talk about the beginning and the end. So 5-year look backs are what we're going to default to. So what happened between year 1 and year 5. However, very quickly, I'm going to kick the training wheels off, and you're going to be responsible for the intervening years as well. Okay? So by the time you get to group project 2, you're going to be talking about the intervening years. But for homework 4, if you just talk about year 1 and year 5, you're okay. Okay? But I just want to start to understand the tree. So we're going to start with the left-hand side of the tree, ROIC, and you'll notice it says EOY ROIC, which stands for end of year, as opposed to BOY, which is beginning of year, which means no plat divided by current year invested capital, as opposed to previous year invested capital. All right? So for McDonald's in 2010, their ROIC was 21.8%. That means if I gave them $1 of investment, they generated 21.8 cents of after-tax profit. 5 years later, in 2014, for that same dollar of investment, they generated 18.9% of after-tax profit, which means their ROIC went down by 13.6% over the 5 years. So, is their ROIC getting better or worse? Worse. The next part is why. Well, we know there's 3 mathematical things that are going to explain why. So let's start with the first one, which is the tax rate. In 2010, their tax rate was 29.3%. In 2014, their tax rate was 35.5%, an increase of 20.9% in the tax rate. Did that help or hurt this ROIC? It hurt it. Because they're paying more in taxes, it's lowering the ROIC. So this driver of ROIC is pushing it down. Tax rates are hurting them. Okay? But if we take out the impact of taxes, we're left with the underlying business, which is the pre-tax ROIC. So how are they doing selling burgers? All right, just the actual business. In 2010, the pre-tax ROIC was 30.9%. In 2014, the pre-tax ROIC was 29.2%. So the underlying business saw its ROIC decline by 5.4%. So one thing we immediately know is that paying more in taxes hurt McDonald's, but that wasn't the only reason why their business got worse. Their business actually did get worse. That's the first driver. Yes?
How did you get 5.4 going from 30.9 to 29.2?
It's negative 5.4. Current minus previous divided by previous. So take 29 minus 30 divided by 30. It's percentage change. That's just a percentage change. Okay, so that number under there is the 5-year percentage change, just to make your life a little bit easier. All right, so now, next 2 drivers, drivers 2 and 3. This is P over S. This is the reciprocal. This is I over S. So this times 1 over the reciprocal is that. So these two have equal weight at driving pre-tax ROIC, margin times productivity. The operating margin went from 31% to 29%. That was a 2-point decline in their operating margin and a 6.7% overall drop. So that clearly hurt the operating ROIC of the business pre-tax. They're making less at every burger they sell. Productivity. In 2010, to generate $1 of revenue, they invested $1. In 2014, to generate $1 of revenue, they invested 99 cents. Is that more or less productive? That's actually more productive. They're spending 1 penny less to generate the same amount of sales. That's actually helping their ROIC. This is the reciprocal. So lower is better. Okay? Because you're using less investment to drive sales. So here's the point. This helped, that hurt. But the operating margin hurt more than the invested capital to sales helped, and the overall pre-tax went down. So the story of McDonald's was drop in margin and increased in taxes more than offset a slight improvement in productivity to drive down their ROIC over 5 years. That's what we know about McDonald's at a high level. That's the first level of analysis. Second level of analysis. What's driving the operating margin? This minus this minus this equals that. Gross margin minus SG&A minus depreciation equals operating margin. These are the three items off the income statement that explain your operating margin. So that's part of our second level analysis. What happened in the income statement that changed the operating margin? Well, gross margin went from 45 to 61. SG&A spending as a percentage of sales went from 9 to 26. And depreciation went from 5 to 6. Okay? Now, this is why I left this example in historically, but notice that if you do look at the intervening years, something weird happened. Gross margin, 45, 45, 62, 62, 61. SG&A, 9, 8, 25, 25, 27. What's up with that? Do you think McDonald's business completely changed its business model in 2012? Probably not. So what happened? These are the evil accountants out there changing how they categorize what goes into cost of goods sold and SG&A. Because notice the operating margin didn't change, but what changed in the gross margin SG&A went dramatically. Now this is an exception, but this is what you got to be careful about even when you do these 5-year trends, right? Because if you actually look at McDonald's, weird stuff starts happening, and it has nothing to do with the change in the performance of the business. It has everything to do with they moved costs that were previously in cost of goods sold to SG&A. For whatever reason, they reclassified. So 2010 and 2014 are an apple and an orange at the second level of analysis. So what is more comparable is 2012 to 2014. 2012, gross margin 61.7 to 61.4, virtually unchanged. SG&A 25.1 to 26.5, that hurt. Depreciation 5.4 to 6, that hurt. The real reason the operating margin went down, which primarily went down between 12 and 14, was because of the increase in SG&A and a slight increase in depreciation per dollar. That's what drove down the operating margins. What's going on in productivity? Dollar became 99. How did it become 99? Well, working capital to sales went from negative 2 cents to 0, right? Even though working capital went from negative 2 to 0, that basically meant they're spending 2 cents more per dollar on burgers and receivables and stuff in the store. So that's an investment. That hurts productivity. Spending on PP&E, that's the actual restaurants and the stuff inside them, went from 91.6 to 89.5. They are more efficient with their store spending relative to sales. And intangibles is the spending in acquisitions. They went from spending 10.7 cents to 10 cents. So they didn't really do a lot of acquisitions. So really the improvement in productivity came from PP&E, came from their stores. Came from their stores and the fact that intangibles went down slightly. And that offset the increased working capital that they had funded in their business. So when I put the story together, it was the decrease in margin driven by higher SG&A spending to convince you to come to the stores, which was slightly offset by the store productivity, okay, led to a drop in the operating ROIC, and they started paying more in taxes, which hurt the overall 5-year ROIC of McDonald's. Using numbers, that's 250 words. Now, let's do another example. Same time period. Next example is Chipotle. This is pre-E. coli, pre-trying to kill you Chipotle. It's back when it was safe to eat there. Right? So, same period, 2010 to 2014. End of year ROIC. How's Chipotle doing? Yeah, couldn't say any better. This is the good old days for Chipotle. Fabulous ROIC. It went from 26.6 to 40.8 per year. That's a 53% improvement in ROIC over 5 years. Taxes help or hurt them? Slightly helped. 1.1% decline in tax rate from 38 to 37. That helped a little bit, but almost all that improvement was pre-tax ROIC. The business itself was doing really well. 41 to 65.5 pre-tax. What was driving it? Margins went from 15.7 to 17.3. Did that help the pre-tax ROIC or hurt it? That 10.4% increase in margin helped the ROIC. Productivity. They went from spending 36.5 cents per dollar of sales to 26.4 cents to generate a dollar of sales. Did that help or hurt? All three factors contributed to positive ROIC. This is back when Chipotle, I don't know if you remember this, but they used to open stores and immediately there'd be like lines out the door. And it used to take you like 20 minutes to go through the lines. All right, that's back when people were not afraid to eat at Chipotle. Okay? And then they started to have E. coli and problems and people stopped going there. So I'm just saying back then, Chipotle would just open up a store and people would just flock to the stores. And you could see the great performance they were having. By the way, same time period, McDonald's was not having that benefit. McDonald's was already starting to have some problems at the same time period with their margins, where Chipotle was expanding their margins, and McDonald's was having trouble with productivity, not just flat. Chipotle was booming because they got lots of sales every time they opened up stuff. Completely different stores. Yes? No. At some point they did, but then they sold it. All right, so operating margin. Second level analysis. Why did it go from 15.7 to 17.3? Well, the gross margin was 30% to 29.9. So really, it didn't change what they made in their food. They actually lost a half cent on their gross margin. For Chipotle, it was all SG&A. SG&A went from 11 to 10. They got a full point out of SG&A, and depreciation went from 3.8 to 2.7. So that's just sales relative to investment. They got lots of sales relative to their investment, and they weren't spending as much to get you to come to their stores. Those really were their good old days. Now, what's happening on productivity? Invested capital sales got better because working capital, negative 1.6 to negative 1. They actually spent a little bit more on working capital, but their PP&E to sales, their store productivity, 36.9 to 26.9. They got 10 cents out of PP&E. And intangibles, they pretty much went from spending 1 cent to nothing. They didn't do any acquisitions. So it was all about store productivity. They'd opened lots of stores. They were pretty much full, driving lots of revenue per store, and that helped them financially. So Chipotle, big improvement in store productivity, simultaneously improving operating margin because of lower SG&A's depreciation, gave them higher pre-tax ROIC at a similar tax rate, driving higher after-tax ROIC over 5 years. All right. At the very end is this mystery company with no name on it. Take a minute, look at the mystery company, and then let's talk about it. your chance to look at it. Yes.
Say that last portfolio, that's fine.
I was just saying that it was their productivity, so it was really the PP&E productivity, 10 cents, coupled with the improvement in SG&A depreciation, which drove their operating margin up 2 points. That together drove their pre-tax ROIC. And as a basically similar tax rate led to the 50% improvement in the after-tax ROIC. You kind of go down the tree and you summarize the final key points of the tree and go in the other direction. Yes? So operating working capital, as you redefined it, is primarily operating cash, inventory, receivables, payables, primarily. Okay? So you just, generally if you have negative working capital, that means you got more payables than inventory receivables, which is pretty constant for a lot of companies these days. They usually don't pay their suppliers, let the suppliers fund the business. That's negative working capital. Okay? So I'm basically using the suppliers to finance my business. Right? So that helps my investment because I'm not borrowing the money because suppliers generally are charging me interest for that. So the idea is negative working capital on a purely financial standpoint means you borrow less money. More negative working capital, less investment. Less negative working capital, more investment. Just about levels of investment. It's not about the appropriateness of it, it's just about the levels of investment. So back to this company, spend a minute, think through the first part of the tree, and then we'll talk about it in about 60 seconds. But just see if you can kind of think through this yourself. Because this is going to be more similar to your assignment that you're going to have to turn in next week. All right. So how's this company doing between 14 and 18? Pretty good? All right. So end of year ROIC went from what to what? 18.9 to 25.9. That's a 37% improvement. So much better ROIC. Was it the tax rate? 31% decline tax rate. Tax rate helped them. They went from paying, what was that, 35.5% to 24.2%. So they're now paying a lot less in taxes. That helped their ROIC clearly. If I take out the improvement in taxes, did the underlying business get better? Yes, because the pre-tax ROIC went up by 17% from 29.2 to 34.2. Everybody see that? Okay. Why did the pre-tax ROIC go up? Was it the operating margin or was it the invested capital to sales? Operating margin from 29 to 42. Big jump in operating margin. Right? Again, a lot more profit on whatever they're selling. And productivity. Did that help or hurt? Hurt. But here's the point. The improvement in the operating margin more than offset the 23.8% decline in productivity. So they were spending more on investments, but they were selling lots of profitable stuff for those investments, so we might give them a pass on that. Okay? Now, second level analysis. Why did this operating margin go up so substantially? Was it the gross margin on their product? Partially. They went from selling things with a gross margin of 44% to selling things with a gross margin of 58%. Did the SG&A change? Barely. Did the depreciation change? 1 point. Even though it's a high percentage, it's 1 point. Really, if you think about points of operating margin, it's almost all gross margin. This company is getting a lot more whenever you buy their product. They're making a lot more difference in price and the cost of the product. McDonald's had a nice run over the last few years. This is McDonald's, by the way. This is post Fix-It McDonald's. This is everyday value menu, dollar menu going out. Now it's the 2 for $5 menu, higher priced items, McCafe stuff, basically It's also the investment in the stores because they're now sprucing up the stores because they were getting pretty shabby. Basically, this is the McDonald's turnaround that you're seeing. And McDonald's is now starting to make money again. Okay, and you can clearly see it in their financials. This is newer McDonald's. Now, what happened on the productivity side, where they spend their money? Working capital went from 0 to essentially 0.03. So not much change in working capital, a little bit that hurt them. But primarily they spent on stores. They went from 89.5 cents to $1.09. So huge spending to open stores and to spruce up their stores. Intangibles went from 10 to 11. They didn't do a lot of acquisition. They spent 1 penny in acquisitions. So almost all that decrease in productivity was spending on PP&E. That's the story of McDonald's. Questions? All right, very quickly. Here's Costco. What you'll notice about Costco, keep it simple, is that they had a consistent improvement of ROIC, and that's the key word for Costco, consistent. Look at those operating margins. Like Costco just plugs along and drives the same operating margin year over year over year. They have the same gross margin, they have the same SG&A, they have similar depreciation. Costco is about as predictable as you can get of a company, right? And that just goes back to Costco's philosophy. Analysts have actually been pushing them to change it. As a customer, I don't want them to change it, which is the whole perception. If you walk into a Costco, you know you're getting a good deal. And that's been their philosophy. Like, they have consistently low margins on everything they sell, and they're okay making 3%, and they literally do it with volume, right? And it's slight improvements in productivity, but even the low margins are making 20% returns, right? So again, nothing else. You can see Costco is the modicum of consistency. Some companies aren't as consistent. McDonald's was not as consistent. Costco is much more consistent. But this is where you're getting a sense of the business. Second analysis you're going to do is on what's called CFI. This is the cash flow analysis. There are 4 drivers of cash flow. Operating free cash flow, non-operating cash flow equals CFI. Then you have your debt and equity cash flow. The 1s and the 2s equals the 3s and the 4s. That was the statement that you just reorganized. So here's the point. When you do the CFI analysis, you always start CFI analysis with free cash flow. So the first number you look at is the operating free cash flow, right? And that's going to tell you how your analysis is going to go. Because if the company has positive free cash flow, then what's going to happen is you're going to be looking to see in your analysis where they spend the money, where to go. If the company has negative free cash flow, then primarily your analysis, where is it coming from? How are they funding the losses? Okay? So to some degree, the free cash flow is telling, and that's where we start. Okay? So let's look at McDonald's historically. Make it a little bit bigger. So 5 years total literally just sums up the 5 years. Again, with training wheels on, we're just going to focus on the total column initially. So we start out, free cash flow, 5 years, $23.9 billion of free cash flow over the last 5 years. They generated a ton of cash. Even when they were struggling, they were generating a lot of cash. Gross cash flow, which is the cash in the income statement, $35.4 billion. Generally increasing every year until 2014 when it went down. Gross investment, 34%, 29%, 49, 34, 10, average 31.7% reinvestment. By the way, what's the payout rate? What's the 5-year average payout rate for McDonald's? Yeah, it's 1 minus the reinvestment. So if they got 31.7 of reinvestment, you know they got 68.3 of payout. That's what I mean by your analysis. So later in our analysis, what they do with the other 68% of the cash. All right, but we'll come to that. But here's the point. They're reinvesting about 1/3, and then the other 2/3 they're distributing in some fashion. That's what our analysis is going to tell us. But what's interesting is how it slowed down in 2014. The other rule of thumb to this statement is depreciation. Okay? So remember that depreciation on the accounting statements is a straight line. So here's the assumption we make in finance. It's an assumption, but it's an important assumption. We assume that a company must spend its depreciation to stand still. If I'm going to tread water, I need to replace what's wearing out. If depreciation is representative of what's wearing out, then spending depreciation means I'm kind of staying in place. Okay, I'm just replacing what's wearing out. If I spend a lot more than my depreciation, that signals I'm trying to grow. And if I spend a lot less than depreciation, well, if I'm not replacing what's wearing out, then I'm not trying to grow, I must not be expecting growth. I must be expecting to shrink. So I say that because this is actually kind of telling, because typically I have to spend to build stuff before I sell it. So companies spending CapEx to depreciation is kind of like a forecast the company's telling you about what they think their growth prospects are going to be, right? I know we're looking at hindsight 2020, but tell me what's going on in 2014 with McDonald's. What's sitting here in plain sight? What's McDonald's depreciation in 2014? You read that number? $1.6 billion. What's McDonald's gross investment in CapEx? $454 million. They got $1.6 billion in depreciation. They got $450 million in CapEx. They're not expected to grow. So I'm telling you that McDonald's was signaling the problems they were having with their stores before they were telling you there were problems with stores, because they stopped investing in their stores. Right? Why would they stop investing in their stores suddenly? Probably because they were having a sales slowdown. So what I'm telling you is, again, hindsight's 2020, but this is a very interesting ratio, because the ratio of depreciation to CapEx is kind of telling you what the short-term forecast is for a company. Now, unless a company's got just a ton of assets sitting around underutilized, which is, again, another symptom of a problem company, then underspending your depreciation says you're not trying to grow. Whereas companies that are spending a lot more in depreciation are telling you, signaling that they expect sales to grow. There's no guarantee that sales are going to grow, but at least it's kind of a proxy for what the company is saying. So we can kind of check that. Okay, so McDonald's generated $24 billion after reinvestment. They spent about $300 million on acquisition premiums. So not a lot of acquisitions given their size. So they had $23.9 billion of operating free cash flow to pay out. Yes?
I had a question about when you were talking about the difference between depreciation and capital expenditures.
Mm-hmm.
I know you said that historical data doesn't predict the future, but if we were to see another situation like this, could we make a similar conclusion?
Well, that's what I'm saying. You got to be careful. The past doesn't 100% guarantee it, but this is what I would start to be suspicious on. If a company is underspending their depreciation, there's probably a reason for that. And they're slashing. So that's the point. It's like, I can't grow if I'm not really spending my depreciation. So it's either I got a bunch of capacity sitting around that I'm just going to reallocate, or I just don't see the growth. Right? The exact opposite is true. If I'm spending 2 to 3 times my depreciation, I'm probably expected to expand. So I'm not saying I'm going to expand, but like, why are you building all this plant? Like, there's a reason why you're building it. So it is a signaling effect. It is something that I want you guys to monitor. This is what I meant by, I know it sucks to do these statements, but when you start putting them in this format, you get some interesting insights about what could be happening to a company. And as an analyst, I'm not saying we know the answer, but these become the questions in the conference call. Like, why are you spending so little on depreciation? You know, what's going on, right? So let's talk about what do they do with the $23.9 billion. Basically, negative 188. They increased their cash balance by 188 million. And so they took that out, but they drew down their non-operating assets by $1 billion, basically generating 24.7 to pay out. So they essentially added another 800 million by selling these non-operating assets. So what did they do with the 24.7 billion? They paid $1.7 billion in interest. What does the negative 4411 tell you? What's negative 4411 mean? Actually borrowed $4 billion worth of new debt. Now, this was a midterm exam question in a previous semester, but did McDonald's need to borrow that debt? Yes or no? There's actually an answer. Did McDonald's need to borrow that debt? Do they need the $4 billion? No. How could I say that with certainty? Because their CFI is $29 billion or $24 billion. I generate $24 billion of cash. I don't need to borrow $4 billion. So why did they borrow $4 billion? Keep that in the back of your mind for just 1 second, that question. Let's keep going. They paid out $14.2 billion worth of dividends, and they bought back $13.6 billion worth of common stock. What's 14 and 14? Approximately 28. What's 28 minus 24? That's what the debt was for. The debt was to buy back the stock. It was clearly a financing choice. Now, don't get me wrong. A lot of companies were taking advantage of all-time low interest rates. Why not? If the market wants to lend me for 30 years at 2%, take advantage of it, right? But I think there was another reason here. As McDonald's performance was getting worse, how do I actually get earnings growth when my earnings are sucking? I buy back my stock. See, this is actually how they were trying to mask, in my opinion, their problems with their investors. Because they bought back so many shares of stock, even though their earnings weren't that great, same earnings or lower earnings, a lot less shares, EPS looks like it's growing. So despite all the operating problems of the business, they were still paying it out. Now, this is not the typical PR line that I'm investing in my company because I think it's undervalued. This is kind of suck, and I'm trying to improve my performance by helping manipulate the shares count. And oh, by the way, as a CEO, I'm tied to the stock price. So if I wipe out the shares, even with poor performance, my share price still keeps going up in the middle of that, and I still get my bonus. Okay? So I'm not saying that this doesn't make sense, because remember, in the key value driver equation, if I have incremental dollars at a negative spread, I don't reinvest them, I pay it out. So it makes sense to pay out. But I'm also telling you, it was clear that this was a discretionary debt borrowing that was driving share repurchase. And they paid out $28 billion over the last 5 years. So you invest in McDonald's, not because the performance of the business is so great. You invest in McDonald's because you like the cash they were giving you. But this is where I would diverge from some fund managers, because I see some storm clouds in this cash flow. So as excited as McDonald's is, and every quarter saying, ooh, dividends going up, here's some cash, I'm buying back some stock. I'm like, yeah, but how could you maintain this? Your gross cash flow is starting to go down, you're not investing in your stores, I see some problems in your margins, your store productivity is getting worse. Like, can you maintain this payout over time? Eventually the bondholders aren't going to keep giving you that cheap debt. So this is where I go back to understanding what's happening in a business gives you a lot more insight than some of the top line stuff that you normally see. What's going on in Chipotle during the same 5 years? Now, Chipotle at the time was a smaller company, but they had $1.8 billion of gross cash flow because they had $970 million of positive free cash flow, smaller company. And they were averaging 48% reinvestment, which was relatively consistent over the 5 years. By the way, 2014, depreciation, CapEx. What's that tell you? Is the food industry having an industry-wide slowdown where people are just abandoning these stores and therefore we're going to cut back? Is that the signal for Chipotle? No, Chipotle is more than 2.5 times its depreciation. They're still in growth mode. So they're in a different spot than McDonald's. It's clear that they expect to continue growing into the future. Where McDonald's is slowing, Chipotle is growing. Matter of fact, that's the point. Chipotle's taking share from McDonald's. People are going to different types of food. What did they do with their $970 million? Well, they actually banked $436 million worth of cash. They just put in the savings. And they bought $400 million worth of non-operating assets. Don't know what they are, but they did. So that left them $139 million to pay out. They got a clean balance sheet, basically no debt. They issued $200 million worth of stock and they repurchased $600 million worth of stock. You might say, well, how does that happen? Well, probably what was happening, I'd guess we look at the footnotes, but they probably had employees were cashing in their stock options. So they're probably selling shares to the employees to reward them, making a ton of money in the early days. The stock price was going crazy. Nobody cared about that. And they were probably offsetting it by buying back some of the stock that they were offsetting with the stock options or being cashed in. But the point is they did all of this. They didn't have to borrow any money to open their stores, and they were still banking $400 million after doing all this. I mean, this is, again, about as good as it gets financially for a company. Nobody knew that they were about to drive the company off the cliff with E. coli and, dirty stores and all the other problems they were having, right? But everything looked smooth sailing at this time, and that's why their stock price was so crazy. Make sense? How did McDonald's do last 4 years? Here's their CFI. Notice any changes? Notice gross cash flow. Income statement cash is now increasing again. What does this tell you? CapEx to depreciation. What's been happening to McDonald's? They're investing again. It's no coincidence if you look back to the ROIC tree of the company with no name, that's because their margins were now spiking, and you're now returning to McDonald's buying the higher menu mixed stuff at a higher rate. So now they're expanding again. And you see that they expect not the level of Chipotle expansion, but they're opening more stores, they're investing in their stores again. And it makes sense because now they think they're getting the returns. Interestingly, McDonald's, still generating $30 billion of CFI, borrowed $16 billion more of debt, purely discretionary, because they bought back $30 billion worth of stock over the last 5 years and paid out another $15 billion of dividend. That's $45 billion worth of payout to their investors over the last 5 years. So they've gone into hyperdrive in returning cash to shareholders. The difference, though, is now they're actually doing it while the performance is improving, as opposed to 5 years ago when they were doing it while their performance was getting worse. So this is why investors like McDonald's again. Questions? Questions about either walkthrough, the ROIC tree or the CFI? What do I need to cover? Use numbers. These are the things you got to cover with the ROIC tree. These are the major things you should be talking about in CFI. Outside of gross cash flow, reinvested rate, and then depreciation ratio is probably the other one I would call, particularly last year or so. Because that's telling as to what the company's going to do for the future. Right? What's happening to non-operating cash flow to get the CFI, and then how are they distributing it? Debt, equity, cash flow. Use numbers, walk through that. 500-word minimum. That's your assignment for next Monday. Company TBD will be posted by Wednesday. Okay? You won't have to do anything in Bloomberg. To do that, I'll give you the trees. I'll give you the CFIs. Whether I tell you who the company is, it doesn't matter. But nonetheless, do the walkthrough. Right? In addition, Group Project 1, EIC. Be ready to do your presentation by Monday. Turn in your PowerPoint by 10 a.m., one person as a team. Okay? And I'll give you the company already. It's called Parker Hannifin. So again, you have Wednesday. The lab will be open all day to work on your EIC as a team and start practicing. If you want, the TAs did presentations as well. So you're welcome to even do a dry run or talk to them during their office hours on Thursday about the EIC part of the assignment. Because to be honest with you, this was their idea. Because we actually didn't do presentations until the very end of the semester, and they actually thought it would help you if you did them along the way. So we're going to kind of do a first presentation, see how it goes. 5% of your semester grade. See you guys next Monday.